Hello friends, this is the market maker levels for Schwab. I think it already bounced from it very aggressively, $7, but these levels are still active. This is more of a bank panic, repetition, jitters. If it gets into these boxes around 40, 43 or this big range, uh, if it comes back to test it again and try to base here, forming cup and handle. How does that look like? You guys already know. If not, there are two patterns which might be of use. Market will base like this. Then they will try to fake out this level, and then it will come down again and then take off. So that is cup and handle. You can wait for this initial risk or the confirmed breakout little later. Other scenario is this also can be played with the W patterns. So let's talk about that quickly. In the W pattern, which also reflects your double kind of bottom, is the inverse of it. So once you find that, you combine this end of it. You combine this point and this point of W, break of this, close above this is a long as well. These are early entries. Now, again, it was just a panic move. Nobody was watching it and no one knew about it. And now we did the measurements. We looked at the contracts. And I think if you were not waiting for it, it was almost impossible to catch it. So let it make a decision. And I think there is a triple witching coming up and a couple of news. Based on that, it may give us a second chance. And what you can do is, if you want to still enter in this area, you can sell the puts 1 year out or 2 years out. Uh, Again, you're taking ownership of the stock at 40 or 43. So look at the premiums on the put, and the shape will be like this, which basically means you're buying something here, and until it goes down to zero, stock goes to zero, you will lose all the money. And if it goes above a certain point, you can collect the premium. And this selling put is what has been working very nicely professionally last 1 year based on the market volatility. Now this panic happens, the volatility is still high. Next 3, 4, 5 days, you can maybe position yourself in such a trade. If you do a vertical spread, bullish put vertical spread, it looks like this. So you're tapping your profit and loss on both sides. But selling put is basically buying stock with the limited upside, and the upside is based on the PMM you receive. So we can adjust this. Maybe if you want to sell like maybe 50, or maybe you want to sell 60, that means you are willing to take the ownership of the stock at 60 within next 1 or 2 years, January expiration, let's say Jan 24 or Jan 25. So you're giving it a lot of room for premium to work out in your favor. So if you do this, that means within 1 year, almost 9 more months, if the stock is above this point, you will keep, let's say you made $1,000 premium, it will be yours. If you're a big fan, if you want to maybe sell a lot bigger, $10,000, it will be yours. And you will start losing money at this point if it goes below that, as you guys know. So the buyer of the put, which is going to be the bank, who is going to be giving you those things, right? So they have all the way to zero. from your strike, they will make money. So what they will do is, if they think there is a value of you losing, right? So what you can do is they will trigger, the buyers can trigger the exercise. So they will trigger the exercise because you have been given advance payment to buy at this strike, as you guys know. And so that means if you buy, let's keep it simple, one contract, $1,000, just for sake of argument, that means you're protected up to $1,000 of buffer. You will be breaking even at that point. And if it goes on quite a lot, and during the week of expiration, maybe earlier, they may exercise it to keep the stock short, and that means you will own the stock at this price, right? So this strategy only helps you to go and with a mindset in the market where you want to own a stock. And if the stock is sitting here, right on the top, where it is right now, 60, and you're selling 40, 45, or 50, that means you're willing to take ownership if you believe in this company and to hold for long term. So you can build your, and if it goes below 50, you already agreed to buy at 40. Plus you got the premium, plus you got the right stock. Let them put it to you, own the stock at 40, plus keep the premium, and you're good to go. If it doesn't come down, like rallies, rallies, and rallies, your maximum profit is also capped for the premium that has been given to you. But that is the plays, various kinds of tactical plays. But this was, again, if it comes back here, I think inside this box, and you can look at the W pattern, the way I explained, or you can also look at cup and handle, let it break, retest it, and then take off. Other pattern also can be what we call as a hockey stick pattern, which is if you want to do some measurements, what we go market may like go like this, right? And then what they do is they always do like this. And this is a scare tactics which we use a lot in professional trading. We call this like a hockey stick, ice hockey stick, right? Or any field hockey stick. That's what they do. Break it, then you buy, you put your buy order here, right? And then take off. So we have W. If it breaks like this, you can go that way. You have cup and handle, let it, this is accumulation, right? Fake out, coming back into it, then break out, you can go that way, right? So, or you can wait for this pattern, cup and hand, this hockey breakout, where it goes, flushes people and panics people, and there we go. Now, again, the strategy is if you want to hold these stocks long term. Thank you very much.